Today eForex interviews Rakesh Shah of Indus Fund Management at TradeTech2010 in London. Hi Rakesh.
Hi, how are you doing?
Good. Just to ask you a few questions, tell us a little bit about your background and how you came to where you are now.
Well, I started off in the mid-90s, initially working at Barclays BZW, which at the time was the biggest player in sterling, and I was working on the leveraged currency trading desk. It was a fascinating time because the Mexican peso was going through a crisis at the time, and all the action in the markets happened to be in the Forex markets. And subsequently we know that 5 years later everything changed and we had the dot-com boom, and that's where all the action was after that. But during my first few years in trading, it was all about currencies. So
you cut your teeth in the Forex markets.
That's right.
And you're now at Indus. Tell us, where you've been between the mid-90s
so
and now.
I spent a few years at BZW, then moved on to ABN AMRO, worked at a number of different trading desks within the prime brokerage structure, and really there I got to learn and understand how different strategies worked in various markets, currency trading markets, whether on the option side, whether on the physical side, and how those fund managers use those to their advantage to really get alpha within the markets for their clients. So it gave me a really good broad understanding of what works and what doesn't work, and I had really interested in it, very fascinated by it, and it led me to understand the markets a bit better from the systematic perspective. So I was always very interested in technical analysis, and as you know, technical analysis is a very large scope field. It can mean many things to many people.
Yes.
But the biggest problem is with analysis, whether it's technical or fundamental, is that as times change, as the structure changes of the market, a lot of it just simply doesn't work. And new things that will work have to be tried and tested, and you have to really be at the forefront of that and test that yourself if you want to have something that consistently works and that is successful.
Right. You're mainly in the automated trading space now, and across a number of different asset classes. How does Forex square up as an asset class relative to the others?
Well, people have to understand that Forex is very different as an asset class to any other asset class, and that's for a number of reasons. Simply put, it is the first asset class that was a 24-hour asset class in the world, and that's very important. So that its development in its nature and the different currency pairs that are traded mean that there is a constant interaction between those pairs, between liquidity zone centers. So when you look at liquidity in whether it's the S&P 500 or you look at the DAX and you compare it to, for example, Eurodollar, it has very different behavioral characteristics. Part of that is to do with the flows that go through the business. So let me be really specific about that. In any other type of business, for example, in the equity market business, you have buyers and sellers of equities. People buy equities, they hold them, and they sell them on at a later date. With the currency market, you have actual physical transaction, one-way flows, in that somebody could buy euros and then they'd never need to go back to the market and resell them. Instead, you have something that's called recycling in nature, where you have some people that traditionally hold currencies and some people that recycle them. So it's a very different type of structure compared to any other market, and that's what makes it very peculiar. And that's where I think that a lot of people come back and they'll, after going through many years in the industry, I find that people that try and put the same strategies in every market won't succeed as well as those that really specialize on just pure Forex strategies and understand that that's a different structural market, so it requires different strategies. And I really think that that's why the Forex market's special.
And how do your Forex models differ from your other asset class models?
Well, for a start, one of the most important things in our modelling that we look at is we do a lot of walk-forward analysis, because simply put, a number of the strategies that we test in the market have no value unless we can really trade them in the market and they make money. But not only that, we have to adapt our models constantly with something that's a subset that are fixed in terms of parameters and a subset that are variable. So it's really important to get that balance correct. So a lot of people think that when you're systematic trading, you set a set of rules, and for the lifetime of that model, those rules never change. What the skill in the art is understanding which rules you can keep and which rules you can change. And if you don't have that skill set, then really you've missed out on the total understanding of what systematic trading is. Certainly there is a rule of consistency, and without that rule of consistency, you will fail. But within that subset, there are structural differences that you will see. For example, as volatility changes, you have to adapt to that volatility change. Maybe when time zones change, your entry and exit signals will change. But you have to know what those things are in advance when you create the model, so that as those things change, you can adapt your model to meet those needs for the strategy to work. So in essence, in the last 90 seconds, I explained something that's quite complex, but when you think about it, it's quite simple in its practice when you place that in the market.
And what time frames do you trade with? How does latency and slippage, for example, affect your performance?
Well, I think timeframes are very important. Now, with any systematic strategy, the way that we follow it is that although we have a number of different strategies working the market in different time zones, we always aim to have a manual person or somebody look over the shoulder of the strategy to make sure it's working constantly. It's not like you could set a black box and walk away and leave it forever. And that is because there are always events in the market that they don't happen very often, maybe every few years, but that they are so extreme that no matter what model you have in the market, it requires somebody physical to sit there and say, look, you know what, this market's just going to blow out all of our risk tolerances. Why sit there and let the market take control of that? You have to let somebody take control of that situation. So we monitor them constantly. So our time frames tend to sit from either intraday, maybe just 60 minutes, 90 minutes to a few hours, right up to multi-entry positions, which could last multiple days. And in fact, some of the best positions you have in the market in currency trading do last a slightly longer time frame than those shorter term. And the reason for that is that if you're going to use leverage, you have to give it time to work for you, and that's one of the reasons why longer term systems do perform very well.
And while we're on the topic of leverage, what kind of leverage do you employ?
Well, we're a conservative, what we'd call a fairly conservative manager, so we don't employ high degrees of leverage. So really 2 to 3 times leverage gives us enough firepower within our toolkit to get above average returns. So we feel that excessive amount of leverage doesn't really help us in terms of our portfolio management. In fact, it just adds risks to the entire portfolio because our game really is to understand that capital preservation is number one, and that's key. In the end, if you don't have any capital, you can't be in the game. So really, capital preservation does come back to the first principle.
You mentioned at times you override the model. In what situations would you not trade with automated models?
So I think the model itself is never overridden, but what I do think is valid is that in extreme circumstances when the markets have exhibit patterns that have never been seen before, and people say that your model should be able to cope with every single circumstance, but you just simply can't program and build that in. So the model will keep on executing and it will keep on placing positions within the market. The only time you'd intervene is when you're close to getting to, when a model suddenly comes from being, you have a very profitable position, it goes very negative, and some really large extraneous, like for example a 9/11 type event happens, then you really want to just step in, take all your risk off the table, because at those times your model wasn't designed to function and take advantage of those large moves. So you're going to take your risk off the table, wait to see how the model performs, and if it stabilizes or if the model's appropriate or if the volatility is appropriate, then you can place your model back in the market. But at those points in time, you should have the writer of the model looking at it to see if it's performing in the way he intended it to perform.
What is your current fund structure, AUM, and your near-term prospects and plan?
Okay, so our current fund, we have 2 principals and 6 researchers within our fund. We're based in Marylebone here in London. In terms of assets under management, we've by the time we always print these things, they're normally out of date, so the best place to look for that is just look for that.
Currently it's April the 20th, 2010, just so everybody knows. Sure,
so just look on our website, Indus Fund Management, and you'll be able to see all those details as an accredited investor to have a look at that. We have what we call substantial assets under management, and in terms of our structure, we very much divide our research from our execution. So our research team just looks wholly upon research, and our execution team just focuses on that. Because part of the business really is understanding, as well as having the models and doing the trading, is getting those trades into the market very efficiently and getting that whole process looked after very well. Slippage is very important in this business, and managing that slippage is a skill and an art in itself. And so we have to deploy some resource and make sure we manage that properly. And
are you onshore or offshore at this moment?
Well, we run mostly managed accounts, so we have a mixture of both. So it really depends on what the client requires as a client requirement. So we're flexible in either side of working with the client to make sure